All right, so we are back here, and this time I'd like to invite our next guest, Artem, crypto who will be speaking about the topic of RWA. And hi, Artem, happy to see you here again. How are
Hi,
you?
Alec. Thank you. Thank you for the invitation. I'm also glad to be here again.
Yeah, for those of our community who are here with us for a couple of years at least, they might remember Artyom's previous talk about DeFi development trends. And this
Yeah,
time we will be having something even deeper and specifically about real world assets and how projects are switching from on chain yield to classical tools in 2026. And I really like the fact that you are bringing some kind of trendy information for each year since back in 2024 you've been giving all the outlines for 2024, and this time we will be having the latest things about RWAs for 2026. And before we
exactly.
start,
Yeah.
could you please just tell us a couple of words about yourself, about your background?
Okay. For those who doesn't know me, I would like to add that my name is Artem. I'm basically a researcher and market analyst right now at moni.ai, where we beyond different like a lot of sets of social analytics products, also doing some trading automation. Plus, we're focusing also on research on the market, which I'm basically involved in. So I'm also an author of the channel called CryptoLamer in Russian-speaking Telegram. And right now, this year, I started my own new project, new YouTube channel about crypto and DeFi stuff. And it's also for the Russian-speaking audience, basically, but it will be focused more on scientific and data-driven analysis of what's happening beyond mechanism that rules the crypto and DeFi stuff. It's called Future of France. So you may subscribe if you wish, and you may compare. Think of it like Veritasium, but for crypto stuff. Yeah, that's basically it.
That's great. Yeah, really happy to hear that. Probably a lot has changed since 2024 when we hosted you back then. And yeah, without further ado, the next 20, 25 minutes are yours. And those of you who
Thank
are
you.
watching this, if you want to ask your questions, please join our Telegram chat and we'll be answering all the questions in text there. And I see that the deck is loaded. It's here on the stage.
Yeah,
And yeah, the stage
yeah,
is yours,
great.
Artyom. Good luck.
Yeah, thank you very much, Alec. Thank you. So, hello, guys, once again. Happy to see you all here. My name is Artem once again, and today we're going to talk about future of money in the perspective of the TradFi money. So, oddly enough, it turned out to be a lot less crypto than all of us imagined and were promised back in like 5 years ago, something like that. And the topic today is RWAfication, which stands for real world assets. Of course, there is like no scientific term for that. What's happening? So this is kind of an observation of what's happening inside DeFi in terms of yield shifting and how DeFi stopped inventing yield out of thin air and started borrowing it, let's say, from the Wall Street instead. So the chart on the left, the entire story in a single line. Tokenized real world assets went roughly from zero to more than $30 billion in 5 years. That's not the whole story. So let's unpack what happened and why it was inevitable. And by the way, all the figures, all the data on the slides of this presentation are as of the 2nd to 4th of June 2026, so it's kind of fresh. So let's switch to the first slide, and let's try to explain what's happening right now inside DeFi. So as you can see with the numbers, so DeFi total value locked is down almost 56% since its spike in 2025, from 180 billion to 80 billion. Sounds like a funeral, but in my opinion, it isn't. It's just a house move. So let's look where it moved. So stable coins are up 55% year over year to more than $320 billion, with the total volume, with the total monthly transfer volume larger, steadily larger, month by month, than Visa plus MasterCard combined. and tokenized real-world assets up almost 5x. And the reason for the move is simple and in some way unpleasant. In April of this year alone, over $600 million were drained out of the on-chain yield. This is the stories of KelpDAO, Drift. Earlier it was Resolve, Stream Finance, etc. So people get scared that their money would be stolen like faster than they could withdraw some profit from the DeFi protocol. So the demand for yield, of course, it stayed, it's here. But what's changed is the plumbing the yield flows through. So the real structural shift is coming with these three categories. First of all, if like 5 years ago, we had like yield from token emission, from farm inflation, from lending API by borrowing some assets. So for now, the sources of the yield are debt of the US government, or funding or delta neutral carry trades, or even dividends from the TradFi companies, and we will talk about it. And in terms of collateral, for example, 5 years ago, we had like native coins of the layer 1 blockchains, some tokens, even meme coins, and even some projects could try to make an NFT as a collateral. But for now, things has changed drastically. For now, most of the backing for the DeFi is a tokenized treasuries, it's private credit, even equities, even real estate, nevertheless. And the distribution of the yield shifted from DEXs, wallets, and those who use these products to the kind of novel new generation super apps, which is we know as like Coinbase, Binance. I believe Hyperliquid is a kind of novel stuff from the last year here. The new channels of distribution here is a specific chains for stablecoins, for fintech, and this where we think that right now there is like nobody wants to rent some block space from some existing chains like Ethereum. Nobody wants it anymore. So Robinhood, Stripe, Kraken, Circle, everybody trying to build their own chain for their own purposes. Nobody wants to be a competitor within some specific L1 solution. I believe this is like kind of the most important slide. So let me linger here. So the emission yield broke, and it's not because anyone and everyone were like villains, scammers, etc., but because the mathematics behind those mechanics doesn't close. So you print a token, and then you dilute your whole token holders. And to stop that from looking like dilution, you need an infinite stream of new buyers for your token. And surprise, surprise, of course, the buyers are always run out. So the examples of Anchor and UST with 20% APY, Olympus DAO, like early phantom chain farms, kind of quasi DeFi, let's say, schemes like pyramids, like financial, call it whatever. So they all died with the same death, emission out on demand, basically. And then in 2022, 2023, rates rose. So when the risk-free US Treasuries bills gives you some yield, like 5% with no risks, so any DeFi yield has to beat that after accounting for this risk of to be on chain. And otherwise, it's not an investment; it's kind of gambling. Yeah, so you're paying you're like accepting a lot of risk with the same yield as a risk-free US Treasury bills. The third thing here, of course, is a trust. Yeah, as I mentioned previously about April hacks in DeFi. Of course, yeah, pure on-chain yield became unsafe in some opinions, at any kind of API. And regarding the fair API in DeFi right now is a huge topic, and it's not the topic and discussion of this particular presentation, but I believe it's something very, very interesting to discuss. And the fourth thing, of course, is the regulation. So the Genius Act explicitly banned paying yield on payment stablecoins, and institutional capital legally cannot touch unstructured yield. So the bottom line here, so the old yield was built on basically on hopes and promises, let's call it so. And the new yield, the new kind era of the yield, is built on the cash flow. You can see the map of the RWA stack in 2026. I would admit only three categories here is basically the rise of the yield-bearing stables, which is like USD by Athena, stake USDS by Sky, USD0 by Onda, and other stuff. It's many, many more of them right now. We will discuss it a bit later. The huge bump in the area of the tokenized equities, we'll also discuss it. And of course, new payment rails, so new RWA-focused chains in different ways for the stable coins itself, for huge companies, for within TradFi, and chains specifically for RWA. For example, this is like Provenance blockchain. What's next? So regarding the yield itself, so right now, basically, in like 5 years ago, every yield was diverged from reality. Yeah, we remember this kind of crazy APIs in DeFi stuff like 100%, 1000%, and we thought it was normal. But in 2026, every yield converges to the treasury rate, to United States treasury rate. And the first anchor here, of course, is the treasury bills, which is now around like 3.5%, which is simply tokenized US debt. And the second thing is a funding carry trade from perps. It's basically within the crypto. When it was the bull market, it was around 15%. When the demand for longs is cooling, like right now, it's about 2%. And the third thing is actually spread credit, delta neutral, like stuff with RWA collateral, which we will discuss. And as you may see with APIs, it's actually the premium for being on chain is gone, comparing to the risk for being on chain. So you used to get paid a few extra points for simply being in crypto and accepting more risk, and you don't anymore. And that disappearance of the premium in a single best proof that RWAification actually happened. Not in theory, but within numbers. You may see it with DeFi TVL and growing RWA numbers. Regarding the base rate of crypto, so you may see the base rate of crypto today is set by something that isn't crypto. So 15 billion across 82 tokenized treasury products are the entire top 5 issuers here at TradFi, and the only one in the third place, Ondo, is crypto native one. And it's only like the visible tip, like the top of the mountain, something like that. And indirectly, through stablecoin reserves, right now, more than 120 billion flows into T-bills. Because USDC, PYUSD by PayPal, USDTB, USDS, all of them are holding their reserves in US government debt. So Wall Street has effectively become the issuer of the crypto dollar layer. And here I'm planned a thought that I'll come back and build later when we will go into talk about risk side. So when the citizen of your country holds what looks like an ordinary stable coin, they're in fact indirectly in a single transaction without asking anyone, taking the direct exposure to the debt of the United States government. remember the thought. We will like make it bigger a bit later. So what's happening within stablecoins? They also aren't DeFi anymore. They became dollar layer. And what's interesting about this is actually the fact that like 5 years ago, the stablecoin was the quote asset inside the trading pair. Yeah, BTC USDT, Ethereum to USDC, and so on and so forth. And maybe it could be like as a collateral inside some lending protocol like app. But right now, stablecoins itself, they have become the dollar layer, 320 billion in market cap, transferring volume monthly more than Visa plus MasterCard, as I said, more than 100 live stablecoins. And this is not just a sector inside the crypto. There are new rails for the dollar. And these rails are eating banks, cards, money market funds all at once. I would admit that USDC-USDT duopoly hasn't gone anywhere, so they're still together. And together they close like 2/3 of the market cap. What's interesting here is actually the growth at the edges, like USD of Athena, USDG by Paxos, USD1. They all posting double-digit money gains. And as you may see in the backing column of this particular slide, you may see that almost everywhere, the backing are T-bills, US Treasury debt, maybe cash plus T-bills. So this entire layer stands on US government debt, once again. Yes, it's convenient, it's liquid, and there's the place where geopolitics will one day ruffle it. But more on that a bit later. So one of my favorite stories here is actually Athena. So Athena sends its own stablecoin USD as a delta-neutral synthetic dollar. Sounds like maximum crypto native. Basis rate, delta-neutral, on crypto exchanges, with a custodian crypto. The whole thing, yeah. And let's look what it's actually backed by right now, today. So liquid stables inside the backing of the USD is 45%, DeFi lending is 43%, and the crypto basis, delta neutral trading, is only around 10%, 1/10. Meanwhile, like 30% of the backing are USDTB plus PYUSD, which are basically US government debt backed stable coins. So the most crypto native yield bearing stable run its own RWAfication really quietly without like no press release nor something. Marketing says delta neutral. The reality says like 90% is no longer basis trading. And almost third of the backing is exposure to US government debt. A clean example of the storefront and the warehouse being two different businesses, actually. And right now, beyond stable coins, it's actually, I believe there are like 3 popular engines behind them this year. So the legacy one, as it was in the beginning of Athena era, Resolve as a competitor, maybe some other protocols. So it was on-chain wrapper for crypto perp basis trading. And now there is something new architecture like Tory Finance. They made seed round in somewhere in March. So the engine doesn't touch crypto at all. So pure arbitrage across global TradFi venues. Projected yield around 15% right now for them. I don't think they're like in live mode right now, but somewhere nearby. And the other big category is structured LWA yield. The leader here, of course, it's Sky Finance USDS, and it's staked wrapped SUSDS. It's around nearly $9 billion TVL. Other examples like Maple, USDTB by Athena, private everywhere is private credit and savings rate around like 3.54%. On top of it, Athena trying to build something new called IUSD, which is basically the same as Story Finance doing. Yeah, and like the treasury markets, as far as I remember, something around $190 trillion. So you may imagine what could be the size of that kind of stable coin, which is doing delta neutral TradFi stuff. Yeah, so now hot topic is also hot topic. The thing is around digital asset treasury companies. They do kind of the same thing, which is RWAfication doing, but in reverse. RWA pulls cash flow from the TradFi into crypto. DATs did the exact opposite. They wrapped crypto inside the equity premium. And when the premium dies, the flywheel spins the other way, as you may see on the slide. So, like, if you're a DAT, you issue shares at a premium, buy Bitcoin, net asset value per share raises, premium justified, repeat the circle. As long as the market to net value is above 1, it's all okay. It's all okay. But in 2026, market to net value dropped below 1 for like most of the DATs, and there are like around 90 copies of what sale are doing with strategy. So when the MNAV dropped below 1, the flywheel reversed. So shares can be issued actively, so you sell Bitcoin to pay dividends with your like TradFi stuff. And the flagship strategy holds around something 800,000 Bitcoins right now. And the first time, like 1st of June, it sold BTC for the first time since 2022, which is like brought to the market some kind of psychological price movement. It's not like it wasn't logical on the 32 Bitcoins. It's nothing for the liquidity of Bitcoin, but in the psychological way, it's really, really harmful. It was really harmful. And across the sector, as I said, like around 90 imitators, and paper losses right now across that DATs like billions. And the moral is simpler here. Yes, so RWA has a cash flow and DAT has a premium. You can guess on the first try which one will survive in the next couple of years. The interesting thing also about DATs, so you may see the flywheel on the next slide again, how it works. The most interesting part that some guys in the DeFi took tokenized STRC tool from the strategy, which is like preferred stock, paying dividends to the holders, and they wrap it, turn it into dividend-backed dollars, stablecoins, yielding around 11 to 60%. And the guys like Saturn Credit and Apex, they actually, as you may see on the slide, they back primarily by STRC of strategy. Yes, that's preferred stocks. And it's interesting, I quote inside the Apex documentation, it backed by public company balance sheets marketed as the safe, transparent alternative to risky opaque trading strategies. It sounds solid, but unwind the chain. So you got BTC, then you wrap it into STRC stuff, preferred stock paying you some dividends around 11.5%, variable dividend, variable, it could be changed. Then tokenize this share, then wrap it inside the stable coin, then you can use it around the DeFi, like put it as collateral, trade it on Pendle, LPing somewhere in DEX and that kind of stuff. And every layer adds yield, adds more risk, and exactly the same amount of distance from understanding what you are actually holding right now, what you actually own, beyond this APY USD. And STRC dividends were funded by strategies selling Bitcoin on the 1st June, as I said previously. So dividend-backed dollar is a leverage-back bet on BTC, actually, just in a stablecoin suit. Both wrappers, by the way, of this STRC traded last week. I didn't check this today, but last week they were traded below peg. $1. Coincidence, I'd be carefully, I would be carefully calling it one. So let's change the mood and switch to some powerful stuff. So right now, those 2 years ago, when like 5 years ago, when DeFi DEX was released, we couldn't imagine that the perpetual DEXs, those non-KYC platforms within the DeFi that allows you to trade something, they're turning into the universal exchange layer for everything. 630 billion in a monthly volume in a single on-chain order book, and is no longer trading just crypto. The concentration is striking like 60% of Perp DEX open interest sits inside Hyperliquid right now. One engine against the long tail of everyone else. But look what they trade. With Hyperliquid improvement proposals 3 and 4, right now you may trade tokenized equities, Tesla, Apple, S&P, all 24/7. Oil, gold, silver, Forex, pre-IPOs, public companies, before they are publicly listed. SpaceX, Anthropic, RWAs, whatever. And prediction markets, like polymarket style. And as far as you remember, New York Exchange closes at 4. CME Exchange closes at 4. Kalshi is, for example, is US only KYC platform. Hyperliquid trades all of it around the clock in one order book, permissionless, fully, without any kind of KYC. So RWAfication dragged TradFi assets into crypto, and Perp DEXs are calmly absorbing Wall Street trading floors themselves. They change in landscape. So Hyperliquid is the super app that holds TradFi, crypto, all other stuff, 24/7, permissionlessly. And it's crazy. And it's really crazy. We couldn't imagine that like 5 years ago. Regarding everything else is also tokenizing, but at a different spreads, at a different speed, sorry. So every asset class is acquiring its own on-chain twin, just at a different stage of maturity. So equities, for example, jumped this year from 32 million to almost 1 billion. Xstocks by Backed Labs does around 95% of tokenized trading on Solana chain, while TradFi like Nasdaq, DTCC, NIS are already coming to the other way. So they trying to build chains under their brokerage system and the reverse Robinhood. So regarding private credit, is where institutional capital actually went. Here is the leader is a figure with around 13 billion in HELOC originations on the Provenance blockchain. I believe it's also like private credit stuff, so you may check it. It's kind of interesting model here. Also, there is some real estate and commodities are lagging comparing to the private credit and the tokenized equities. But the leaders here are basically Mantra blockchain with the MAC agreement around with the tokenization of around 1 billion plus Dubai real estate. And
Artem, sorry to interrupt you here, but we need to wrap it up, unfortunately, for the sake of the time limitations. And yeah, if you have this kind of summary or conclusion thing,
yeah. So So yeah, regarding the last thing here is I would add is about um, regulatory stuff. I believe you will discuss today also something regarding Clarity Act and Genius Act. But in the end, I would admit that um, regarding stable coins and this US debt, regulatory cliff and geopolitics. So US government debt, um, to have it with your own citizens is deeply uncomfortable for non-US states. So your citizens selling transactional without asking and regulatory takes direct exposure to long-term debt of another country. And I believe this is the huge risk of political tension in that sense, and between governments and states. So we will see how it goes. The interesting thing to look for the next year, I believe, is basically to check how the risk moving from the smart contract exploits to the area of this TradFi to DeFi connection unwind, for example, for stable coins. And of course, we see the new numbers growing in RWAfication and RWA crossing like 50 billions, 100 billions, and etc. And we will see what's going on with the Clarity Act, of course. Hope there will be no digital asset treasuries collapsed, but we will see. It's one of my predictions for the next year, unfortunately. Okay, that's it. Let's stop here.
All right. Yeah. Thank you so much, Artem. And we will be keeping the conversation about this topic in the Telegram chat. So whenever there will be any questions, let's continue them in text. And yeah, thank you again, Artem. Really appreciate the clear breakdown of how DeFi is shifting and what RWAfication actually looks like in the numbers in 2026. And thanks for joining us today and enjoy the rest of the conference. And
thank you. It was
all
a
right,
pleasure.
everyone.
Thank you.
Yeah. And so we are going on to move to our next speaker.